Hi everyone. In today's class, we are going to be dissecting adjusted present value APV, a very challenging but very interesting topic in strategic financial management. Of course, APV is embedded under capital budgeting. However, I will take my time to explain the underlying concepts and procedures involved in determining financial viability of a project using adjusted present value. For this purpose, what is adjusted present value? Simply put, APV is a technique designed principally to evaluate a project when a company is diversifying and financial risk or debt equity proportion of the company is expected to change significantly as a result of undertaking a project. I repeat, APV is a technique designed principally to evaluate a project when a company is diversifying and financial risk or debt equity proportion of the company is expected to change significantly as a result of undertaking a project. It is a technique that separates cash flow from operations from the cash flows arising from financing and appraise each of them independently. Distinctively, APV should be used to appraise a project when issue cost or subsidized loan is given or is provided in a question. Technically, that is what APV is all about. Therefore, how do you calculate adjusted present value? So let me switch to the working notes to explain on how to calculate adjusted present value. When you are computing adjusted present value, there are four procedures to be considered. Calculating adjusted present value. So there are four procedures to be considered. Step one is to calculate base case NPV. Step two, you calculate PV, determine the present value of financing effects, cash flow. Okay. Then step three, calculate the adjusted present value. Then step four, advise on the acceptability of the project. So these are the four procedures you are expected to carry out whenever you want to compute the adjusted present value. It could have been very easy if you can just go to the question, add 1 plus 2 and get the base case NPV, or just add one or two numbers and you get the PV of financing effect cash flow. So it's more than that. Each of step 1 and step 2 has its own underlying procedures that you are supposed to carry out. So let's take it one by one. Remember the promise I gave to you that I will take my time to explain the underlying concept of adjusted present value. Therefore, let's calculate base case NPV. Okay. Number A, calculating base case net present value. How do you do this? There are four procedures that you are going to undertake. whenever you want to compute base case NPV. Step 1 is to calculate net cash flow. Calculate the net cash flow. Take into consideration all relevant cash flows. Considering all relevant cash flows, including sales value, variable costs, specific or attributable fixed costs, initial outlay, working capital, inflation, taxation, etc. All those things you normally do when you are computing the net present value. So you are still going to do it when you are calculating the base case NPV. You go to the question, do you have selling price? If yes, then go and inflate the selling price if you are given inflation rate. Do you have variable cost? If yes, go in there, inflate the variable cost. If you have inflation, then of course, and then you come and post. So all those normal adjustments you make when you are computing the net present value is the same thing you are going to do. In fact, there is no difference between base case NPV and the normal NPV. The only difference is that instead of you to use the cost of capital of the company, instead of using the existing work of the company to appraise the projects or to compute your NPV, you are going to use the cost of equity on gear. That's just the difference. So I will then go to step 2. Step 2 is to calculate cost of equity on gear. Calculate cost of equity on gear. Okay, how do you calculate cost of equity on gear? There are 3 different ways in which you can calculate the cost of equity on gear depending on the information available for the proxy company. So, for example, if the proxy beta is given, or if proxy beta is given, then how do you calculate cost of equity on gear? Very simple. If you are given the proxy beta, there are 3 procedures you are supposed to carry out. The first procedure is to identify the beta. Identify the proxy beta in the question. Step 2, ungear the beta. Ungear the beta if geared. So the beta will be geared. The beta you have identified in step 1 will be geared if in the question the proxy company has debt in its capital structure. So simply put, the gear beta the gear beta is the beta of a company that has debt in its capital structure. So step 3, however, if the proxy company does not have debt in its capital structure, that is, the proxy company is all equity company, then you are going to skip step 2 and move to step 3. Step 3 says we should calculate cost of equity ungeared. Calculate cost of equity ungeared, which represents capping. Okay, capping is the cost of equity ungeared. So you already know the formula for calculating to ungear. Okay, however, let me assume that you don't know the formula for to ungear. So let me just give it to you before you move to step 3. So ungear beta simply means asset beta. Therefore, the formula you are going to use will depend on whether you are given debt beta or not. But where the debt beta is assumed to be risk-free, then the beta asset beta will be calculated as beta equity of a gear company multiplied by equity value divided by equity plus debt 1 minus tax. Okay, so where debt beta is assumed to be risk-free, this is the formula that you are going to use. If I don't want to use this formula, I can also say beta assets equal to beta equity of a gear multiplied by 1 divided by 1 plus 1 minus tax. All of this multiplied by debt equity ratio of the proxy company. Okay, so I can either use this or I use this. Any of the two, I will get the same answer. However, like I mentioned, this formula is used. These two formula is used where debt beta is assumed to be risk-free, where debt beta is assumed to be risk-free. That is, the debt beta is equal to 0. Okay, so you only use this formula where debt beta is assumed to be risk-free. However, if you are given debt beta, you need to use the extended formula. So if that is the case, I would then say, of course, using the extended formula, so the beta assets will then be equal to beta equity of a gear multiplied by equity value divided by equity plus debt 1 minus tax. Keep this on one side plus the other side. Debt beta multiplied by debt value into 1 minus tax divided by equity value plus debt 1 minus tax. So this is the extended formula you are going to use when the debt beta is given in the question. Okay, so any of these formulas you can apply to calculate the beta assets. You then move to step 3. Step 3 says calculate cost of equity on gear. Calculate cost of equity on gear. That is, you calculate capping, capital asset pricing model. Of course, capital asset pricing model denoted as KE, cost of equity equal to the risk-free rate of return plus the beta in step 2 multiplied by market return minus risk-free rate of return. Okay, so these are the 3 steps that you are going to carry out whenever you want to compute the cost of equity on gear. So then I move to step 3. Step 3 is to calculate. Okay, step 3 of calculating base case NPV is to calculate the present value. Estimate the present value by multiplying the net cash flow with the discount factor using the cost of equity on gear. Then step 4, you then calculate the base case NPV. Calculate the base case net present value, okay, which represents, okay, this represents the difference between the PV, the difference between positive, the difference between positive and negative present value. Okay, that's it. So these are the procedures you are expected to carry out whenever you want to compute the base case NPV. Okay, so let's move to step 2. Step 2 says you should determine the PV of financing effect cash flow. How do you then calculate the PV of financing effect cash flow? Number B, so calculating the PV of financing effect cash flow. Now, this is where the students find it most challenging, and this is why APV is more technical than the NPV. You can see that in the first step, which is calculating the base case NPV, you're already familiar with how to compute NPV. The only difference is just the fact that you are using the PV, you are using the cost of equity on gear to discount your net cash flow. That's just the difference. However, the PV of financing effects, the PV of financing effects cash flow is something you have not done before, and this area is more technical than the first one. Therefore, let's determine PV of financing effects. So, there are 3 stages of calculating PV of financing effects. However, I will add additional 2 variables, making 5 steps. And each of the last 3 steps have its own underlying procedures. Therefore, when you want to compute the adjusted present value, the first thing first that you need to do is to ascertain the discount rate to be used for the financing effect cash flows. So step 1, ascertain the discount rates to be used for cash flows arising from financing Okay. Now, the Miller and Modigliani are the ones that propounded the adjusted present value technique, and they failed to tell us the discount rate to be used for discounting cash flow arising from financing. Therefore, you are at liberty to either assume cost of borrowing or risk-free rate of return. Whichever one you use, you are good. Therefore, under this, you can either assume, assume either of A, cost of borrowing, that is the interest rates, or risk-free rate of return. Okay. Risk-free rate of return. So whichever one that you assume, you're good to go. All right. But what is important is that you have to stick to your assumptions. Okay. That's step one. Then step two, you also need to ascertain whether you want to use gross finance required or net finance required for the cash flow arising from subsidized loan and tax saved on interest. So again, ascertain whether ascertain whether net finance required, net finance require or gross finance require will be used for cash flows arising from subsidy or arising from subsidy and tax saved on interest. Okay, so you need to ascertain this from the beginning before you begin to compute. Before you begin to compute the present value of financing effect, these two line items must be confirmed. So once you are done, of course, in most cases, I will advise you always use the cost of borrowing as the discount rate for financing effect cash flow, because cost of borrowing is always higher than the risk-free rate of return. Okay, then you must determine whether you want to use net finance required or gross finance required for subsidized loan or tax saved on interest. So once you have this certain, then you can then go to the main procedure for calculating adjusted present value. Okay, let me call it 3A. 3A. So calculate PV of issue cost. When you want to calculate PV of issue cost, there are three procedures you must consider. But first thing first, what do you understand by issue cost? Issue costs are costs associated with underwriting and raising debt equity capital. Let me take it again. Issue costs are costs associated with raising and underwriting debt and equity capital. Okay, so the issue costs arising from debt has tax deductibility benefits. Of course, there is no tax relief when you raise capital through equity. All right. Examples of issue costs include marketing expenses, 2, regulatory fee, the amount paid, the fee paid to the Security and Exchange Commission, that's regulatory fee or registration fee. 3, professional fees like auditor's fee, legal fees. Then you have investment banking fee. These are the examples of issue costs. You know, for example, when a company wants to raise initial public offer, the company wants to raise capital through initial public offer. The company cannot just go to the public and raise the funds. It should be through intermediary, and it is investment banker that will stand in between the company and the public to raise the funds. So when the company is raising the funds, there will be some expenses the company will incur, like I mentioned to you the other time, which one of them is the registration fee paid to the Security and Exchange Commission. The auditor may need to audit the financial statement of the company to be ensured that it presents a true and fair view, or is fairly presented. Okay. Not only that, the lawyers will need to come in to review the document or prepare some documents, legal documents associated with the capital that the company wants to raise, or anything that relates to the company. So all these expenses are what that will be incurred before the company even receive the funds that the company wants to raise through the public. All right. So these are the things you need to consider as far as issue cost is concerned. Therefore, how do you then compute the present value of issue cost? Like I mentioned, there are three procedures you are going to carry out whenever you want to compute the PV of issue cost. Step one is to calculate issue cost amount. Okay, determine issue cost amount, ICA. How do you determine issue cost amount? The issue cost amount will be computed. Let me write this. ICA is computed as the gross finance required multiplied by issue cost rate. So the proportion of issue costs, the percentage of issue cost is the issue cost rate. So you use it to multiply the gross finance required. That will give you the issue cost amount. Then step two of this is to compute the present value of issue cost. Okay, calculate the present value of issue cost. Let me write this. Present value of issue cost amount in year zero. How do you do this? There are two stages depending on whether there is debt and equity. So if you are given debt and equity, then the PV of issue cost amount on debt will be calculated as the issue cost amount on debt multiplied by discount factor at year zero. Whatever you have, put it here. Of course, this must be in brackets. Then you also need to calculate the PV of issue cost amount on equity. So you then say issue cost amount on equity multiplied by discount factor at year zero. So you also put it there. So add the two of them together to give you this. That's total PV of costs. Total PV of issue cost amounts. Okay. So then step three now. You need to add to that. Step three, you consider or you calculate the present value of tax saved on issue cost amount. Calculate the PV of tax saved of issue cost amount on debt. Remember what I explained to you earlier on. There is no tax benefit on equity, but when you have debt, you must consider the tax benefit or tax relief on issue cost amount in year one only. In year one. only. Okay, how do you do this? What's the formula that you can use? So the PV of tax saved on issue cost amount on debt in year one will be calculated as the issue cost amount on debt multiplied by discount factor at year one, discount factor of year one. Okay, so whatever it is, you then add it to this. This one is a saving, so then add it to that. At the end of the day, you have this guy. So this is the PV of PV of issue cost. Okay, so these are the procedures you are expected to carry out whenever you want to compute the PV of issue costs. Okay, the PV of issue costs. So that's that. So this next stage, 3B now. Calculate the PV of net subsidy. How do you calculate the PV of net subsidy? There are 4 steps that you are supposed to carry out. The first step is to calculate subsidy amount. Step 1, calculate subsidy amount. Let me write that. Subsidy amount. SA. How do you calculate subsidy amount? SA equal to the gross finance required multiplied by the proportion of subsidy. Okay, now when a company wants to borrow, the money that the company will receive at the end of the day is the net amount. The initial outlay and the working capital is assumed to be the money that the company will receive, which is the net amount. Okay, so examiner will tell you that out of the gross finance required or the net finance required, you may be told that 30% is for subsidy. So if 30% is for subsidy, it means that the balance of 70% is true normal borrowing. If you are told that 70% is for subsidy, it means that the balance of 30% is true normal borrowing. So, of course, the proportion of how the financing is done will be given to you. All right, so that's that. So first thing first, for you to get the PV of net subsidy, you need to calculate the subsidy amount or the amount attributable to subsidy. So, and this is how to do it. Just multiply the gross finance required with the proportion of the subsidy. Then step 2, you calculate savings of subsidy. Determine saving on subsidy in percentage. How do you calculate savings on subsidy? Let me rewrite this. SOS in percentage. All right. Therefore, SOS, saving on subsidy, is calculated as the normal borrowing rates, okay, minus subsidy rates. So NBR minus SR. The normal borrowing rate is the interest rates associated with normal borrowing when you borrow through your bank or in the public. So the interest rates the company will pay on the loan borrowed is the normal borrowing rate. Then the subsidy rate is the interest rate on the subsidized loan. All right. So the difference between the two, the difference between the normal borrowing rate and the subsidy rate represent the savings. Remember, anything that is subsidized is usually cheaper. So subsidy is a cheaper, will come at a cheaper price relative to the market price. Okay. So the difference between the two is the savings. Then step 3 now is to determine net subsidy. Calculate net subsidy. NS. How do you calculate net subsidy? Net subsidy is calculated as subsidy amount multiplied by savings on subsidy in percentage multiplied by 1 minus tax. Okay, multiplied by 1 minus tax. This will give me the net subsidy. Then finally, step 4, I need to calculate the PV of net subsidy. Calculate the PV of net subsidy. To do this, I would then say PV equal to net subsidy in step 3 multiplied by annuity factor. Okay, multiplied by annuity factor. All right, of course, you know the formula for computing annuity factor. Remember, the discount rate that you have assumed in the step 1, whereby, I remember I mentioned that you can either assume cost of borrowing or risk-free rate of return. So whatever the discount rate that you have assumed is what you are going to use to discount the PV arising from financing. Okay, so these are the procedures that you are going to carry out whenever you want to compute the present value of net subsidy. The last one is to compute the PV of tax saved on interest. So this is 3C. Calculating PV of tax saved on interest. Okay, PV of tax saved on interest. To do this, there are 3 procedures you are expected to carry out. The first step is to calculate or to determine all interest elements, accumulate all interest elements. Okay, step 1, accumulate all interest elements. What do I mean by that? There are 2 stages of financing: through normal borrowing and the subsidy, for example. Therefore, you are going to determine the interest expense the company will pay on normal borrowing and the interest expense the company will pay through subsidized loan. So you now add the 2 of them together. So I would then say interest on borrowing, which should be calculated as the gross finance required multiplied by the proportion of normal borrowing, proportion of normal borrowing. Then multiply by the interest rates, normal borrowing rates, the interest rates on normal borrowing. Okay, that will give me the interest on borrowing. Then, of course, I will then determine the interest on subsidy, which will be calculated as gross finance required multiplied by the proportion of subsidy. Or I can simply say multiply by SA, subsidy amount, then multiply by the interest rate on the subsidized loan. So whatever I have, I will add the two of them together. That will give me the total interest. So total interest, which should be equal to interest on normal borrowing okay, plus interest on subsidy. You add the two together, that will give me the total interest. Okay, once I have the total interest, then I will go to step 2. Step 2 says calculate tax saved on interest. Calculate tax saved on interest. So tax saved will be calculated as total interest multiplied by tax saved multiplied by company tax rate. So you are going to multiply the company tax rate on the total interest. Okay. Then finally, step 3, calculate the PV. Calculate the present value of tax saved on interest, which is PV, will be calculated as the tax saved multiplied by annuity factor. Okay, so whatever I have, of course, that's it. So these are the procedures of calculating the PV of financing effects. So the last one, which is of course step 4 now, is to then calculate the PV of financing effects cash flow. To do this, I will pick the PV of issue cost. I will post, usually to be in brackets. Then I will add PV of net subsidy, if any. It is not compulsory that in a question that you are going to have subsidy, interest, and all of that. Whichever one that you have is what you are going to compute for. Tax saved on interest. So you add the 3 of them together. So it could be positive or negative. So this is the PV of financing effects cash flow. So these are the procedures of calculating the PV of financing effects cash flow. So once this is done, then you can then calculate step 3 now. Calculate the adjusted present value. Remember, step 1 is to calculate the base case NPV. Then step 2 is to calculate the PV of financing effect cash flow, which is what we just did. Then step 6C now is to calculate the adjusted present value. So step C calculates the adjusted present value. So how do you do this? The adjusted present value will be computed as the base case NPV plus minus the PV of financing effect cash flow. So PV of financing effects, it could be positive or negative. Your APV could be positive or negative. So this is adjusted present value. Of course, the last step is to advise on the acceptability of the project. So if APV is positive, accept the project. Just the same way you do for NPV, the same decision rule you have for net present value is what that will be applied for APV. But if APV is negative, you reject the project. That's that. So these are the procedures for calculating adjusted present value. Okay, these are the procedures for calculating adjusted present value. So the next thing we want to do now is to have an example. Okay, let's have illustration to demonstrate our understanding on the adjusted present value. Okay. So if you have, once you have this material, you can go through all the line item, all what I've discussed today. They're held in details. Okay. Now, again, in the calculation of the cost of equity on gear, remember I told you there are three procedures, or there are three ways you can calculate the cost of equity on gear. The one I gave to you is where the proxy beta is given, which I told you are going to carry out three procedures. Okay, you carry out three procedures. Step one is to identify the proxy beta. You ungear the beta if it is geared, then you calculate capping. So another way, if you are not given the proxy beta, examiner can also give to you cost of equity of a proxy. So if you are given cost of equity of a proxy, you are supposed to calculate cost of equity using Miller and Modigliani formula. Remember, I told you when we had cost of capital that there are three ways of calculating cost of equity depending on the information given. Number one is that you can use dividend valuation model to calculate cost of equity. You can use capital asset pricing model to calculate cost of equity. And I told you capital asset pricing model is a topic on its own. Then three, you can use Miller and Modigliani formula to compute the cost of equity. And I told you when we get to adjusted present value, we are going to demonstrate the use of the Miller and Modigliani formula. So if in the question you are given the cost of equity of a proxy company, so in that case, for you to be able to calculate your cost of equity on gear, of course, this is the formula, this is the Miller and Modigliani formula that you are expected to use. So the cost of equity of a gear company, that's a proxy company. So what you are looking for is this cost of equity on gear, KEU. KEU is what you are looking for. It's not given to you. Therefore, you apply it in this formula. So you go to the question. This KEG, this keg will always be given to you. It could be 10%, it could be 20%, it could be 15%. So you come and put the percentage given to you here. Forget about the percentage behind the number. Then, of course, you now work for KEU. Your KD, this KEU, like I said, is not given to you. That's what you want to solve for. Therefore, the KD is the interest rate, is the coupon rate on the debt. So, for example, you may be given 8% bond or 8% debenture or 10% debenture. So that 10% is the interest rate associated with the debt. That's the coupon rate. So, of course, you come and slot in there. However, if in the question you are not given the cost of borrowing, then you are going to assume risk-free rate of return as the cost of borrowing for the proxy. Then the D here is the debt value of the proxy. E is the equity value of the proxy. At times, examiner will give to you the debt equity proportion. examiner can tell you that debt equity proportion is equal to 30%. So if the interpretation is that D is equal to 30%, then equity is equal to 70%. Equity is equal to 70%. If you are given debt equity ratio of, say for example, 40%, it means that debt is equal to 40%, then equity is equal to 60%. Okay, equity is equal to 60%. So you must know all of this. Of course, we have done this when we had the cost of capital. So please, it's still the same thing. All right. So this is the formula you are going to use to calculate your cost of equity on gear. Then the third way is that if you are given the WACC of the proxy company, in this case, you need to calculate the WACC of on gear. The WACC of on gear is the same thing as cost of equity on gear. All right. So to get the WACC of on gear, the WACC of a gear company, this formula will be, this WACC of a gear company will be given to you. What you want to solve for is the WACC of on gear. Okay, then of course multiply by 1 minus debt value, multiply by the tax rates, then divide by equity value plus debt value. Okay, so that is for that. Remember, like I said, the WACC from gear is the same thing as cost of equity on gear. But what is common when you want to determine the cost of equity on gear? Of course, proxy beta may be given to you. Cost of equity of a proxy may also be given to you. But this WACC of a proxy is not common. All right, it's not common. So watch out for that. Okay. So you can just go through the material to read more on those details. All right. So we have done all of this. Okay. I've done all of this. So remember what I said. The net finance required is assumed to be the initial outlay plus the working capital. So it is assumed that the subsequent working capital will be financed through internally generated funds. Okay, so that's that. So these are the examples of issue cost I mentioned to you earlier today. Okay, these are the examples. Okay, so at this point, so let's calculate. Let's solve question. Let's solve question. Let me see if there are other things you need to. Yes, of course, you can just read the advantages and disadvantages of adjusted present value. All of this. So it's self-explanatory. So at this point, let's have illustration. Let's have illustration. Okay. All right. So let me see. Yes, we are going to have two illustrations. Let's solve the first one. Tripatoli PLC is a company currently engaged in the manufacture of baby equipment. It wishes to diversify into the manufacture of snowballs. The information relating to the investment are shown below. Something has caught my attention. Examiner has mentioned that this company is diversifying. Okay. Number one, additional information. The new project will involve the purchase of new machinery for a cost of 8 million naira. At the end of this time, the scrap value is expected to be 1,200,000. So I've seen initial outlay. Here is initial outlay to be 8 million. Here is the scrap value. Okay. 2. The project is expected to generate annual cash flows in revenue of 6 million naira in the first year and increase by 5% for the next 2 years. So I can see sales value here, and I'm also given the inflation rate for the sales value. 3. Information number 3. The annual production cost is estimated to be 1.2 million in current value terms. This will be affected by inflation at the rate of 3% per annum. Remember what I explained to you when we're having capital budgeting, when we're having net present value, when we discuss relevant cash flows and inflation, I mentioned to you when cash flow are stated in current value terms, inflation should start from year one. You can see that the revenue, you are given revenue in the first year terms, so you should know what to do. Then number 4, the incremental annual fixed cost relating to the project is 150,000 naira. Here is the fixed cost. It's relevant because it's incremental, so it's relevant. We are told that this will not be affected by inflation. No inflation rate on the fixed cost. Number 5, corporation tax is payable in the same year in which the profit is earned at the rate of 30%. Okay, so this is tax. The machine will attract written down allowance of 25% per annum on a reducing balance basis with a balancing allowance at the end of the project life when the machine is scrapped. So there's capital allowance rate of 25% on the machinery. Okay, an examiner has mentioned that it must be on a reducing balance basis. Number 7, the company's equity beta is 1.27 and its current debt to equity ratio is 25 to 75%. However, company's gearing ratio will change as a result of the new project. So something is calling my attention in this note 7 that this project will be financed, will be appraised using adjusted present value. In the first paragraph, examiner has told us that the company is diversifying. Now again, in this note number 7, examiner is telling us that, however, the company's gearing ratio will change as a result of the new project. Remember, I mentioned that APV is used when a company is diversifying and financial risk or debt equity proportion of a company is expected to change as a result of undertaking a project. So that's to tell you that in this particular question, we may likely use, even though I've not seen the requirements, then we may likely use the adjusted present value to appraise the project. Then number 8, Xterra PLC is a company that is involved in snowboard manufacture. It has an average equity beta of 1.19 and an average debt to equity ratio of 30 to 70%. So the name of this company itself is Tripatoli. The name of the company is Tripatoli. Another name has been mentioned as Xterra. So this is where you do have the information of a proxy company. When you see a name that is different from the main company, that new name is the proxy company. So here we have been given the information of a proxy. So examiner told us that this proxy has equity beta of 1.9. Equity beta could be geared or ungeared depending on whether the proxy company has debt in its capital structure or not. So examiner has told us now that this proxy company has equity beta of 1.9. Okay, and we are given that average debt to equity ratio is 30 to 70, which means that the 1.19 is geared because we have been given debt equity proportion to be 30%. Then number 9, assume that the debt is risk-free and that the risk-free rate of return is 10%. Okay, so here is the risk-free rate of return, which is 10%, while the expected return of the market portfolio is 16%. So here is the market return, 16%. The financing information include the new investment will be financed as follows: debenture, redeemable in 3 years' time, 40%. Right issue of equity, 60%. The issue cost are 4% of gross equity issued. The issue costs are 4% of the gross equity issued and 1.5% of the gross debt issued. Assume that the debt issue costs are tax deductible. So in this case, examiner is now asking us to advise whether the company should go ahead on the diversification plan for snowboards. So Without, you can see examiner did not tell us whether we should use adjusted present value or NPV to appraise the project. But in this question, I can see issue cost. I can see issue cost. Okay, it means that I'm supposed to use APV to appraise the project. Of course, based on what I just read, there is nothing like a subsidized loan. There's nothing like subsidized loan. So that means this project will be, we only consider the only method of financing the project is through debt and equity. So we are told that debt of 40%, then right issue of equity of 60%. So an examiner has told us that we should use the gross finance required because we are told that the issue costs are 4% of the gross equity issued and 1.5% of the gross debt issued. So, and you're also told that the debt issue costs are tax deductible, which simply means that in year one, you are supposed to calculate tax saved on issue cost amount on debt, tax saved of issue cost amount on debt in year one only. All right, so that is the question. Now, how do we solve this question? First thing first, remember, there are 4 procedures you are going to carry out whenever you want to compute the adjusted present value. The first step is to calculate base case NPV. All right, you keep it on one side. The second step is to calculate the PV of financing effect cash flow. Then step 3 is to calculate, the adjusted present value. And the last step is to advise. And the examiner is asking you to advise whether the company should go ahead with a diversification plan for snowball. So if that is the case, let's solve this question. Now, of course, in solving the question, the first thing you need to do, I will go to the question. If I'm given, there is no need for you to be reading all over again the question. You've already read through and you know what you want to do. We have identified from the question that the best technique to appraise this project is to use adjusted present value. Why do you think so? Because the company is diversifying, and we are also told that as a result of undertaking this project, debt equity proportion will change significantly. Therefore, we are supposed to use adjusted present value. Even at that, examiner also mentioned in the question that we are given issue cost. Because we are given issue cost, it's 100% certain that we are supposed to use the adjusted present value to appraise the project. Therefore, let's compute the base case NPV quickly within the next few minutes. Let's compute the base case NPV. To get the base case NPV, I will then go to the question. I want to calculate my cash flow for revenue. Where do we have information on revenue? When you look at the second bullet point, additional information number 2, examiner has mentioned to her that the project is expected to generate annual cash flow in revenue of 6 million naira in the first year, which means that we should start inflating from year 2, and the inflation rate is 5% for the next 2 years. So first thing first, also I need to ascertain what's the useful life of this project. Okay, what is the useful life of the project? Right, let me identify again. Examiner has already told us though that we should inflate the revenue for the next 2 years, which means this project has 3 years life, which means the project has 3 years life. So if that is the case, how do you then do this? Okay, how do you then calculate this? So I want to go and calculate the PV of the I want to inflate the revenue now. Let's inflate the revenue. So if that is the case, let's go down there and do our working for revenue. Now, for me to do working for revenue, what I will do is to bring out your calculator. I want to inflate revenue. How am I going to do this? Simply because our revenue of 6 million naira is in first year prices, meaning that you should start inflating from year 2. Therefore, I will then pick my inflation rate is 5%. I will say 1.05. Okay, let me do that again. 1.05 multiplied by 6,000. Our numbers are in thousands. That will give me 6,300. That is how we got this 6,300. So that's 6,300 multiplied by 1.05. That will give me 6615. So with this, I've inflated the revenue. Then I will go and post. Okay, I will then go and post. All right. So this is the working number one. So that's for that. I will then go back to the question. Am I given variable costs? Let's go and identify variable cost. In information number 3, you are told that the annual production cost is estimated to be 1.2 million in current value terms. Okay, so our production cost, under production cost, you have your direct material, direct labor, direct expenses, and variable overhead. All of them has been matched together. And the examiner told us that it's 1.2 million in current value terms. So, and the inflation rate is 3%. So let's go and inflate that. Inflation should start from year 1. Okay, so production cost. This is the working for production cost. The production cost for currently we are told that is 1.2 million. Therefore, I will then carry my calculator. 1.03, that's the inflation rate, multiplied by 1.2 million. So that will give me 1236. That is how we got the first 1236. Then for the second year, I would then say multiply by 1.03 equal. That's 1273. That's how we got this 1273. What you have in your calculator multiplied by 1.03, that will produce 1311. That's how we got the 1311. So let's go and post. So that's our working number 2. So this is number for production cost. I will then go back to the question, what other relevant cash flow do I have? So examiner has told us that in note number 4, you are told that the incremental annual fixed cost relating to the project is 150,000 naira. This will not be affected by inflation. Since my incremental annual cost is not affected by inflation, I don't need to go and do workings. All I need to do is to just post straight. So this is the incremental fixed cost, 150,000 naira for each year. All right. So I will then go back to the question, is there any other relevant cash flows? Okay. Yes, when I was reading, there is no other relevant cash flow that I indicated or I noted in the question. Therefore, there is no other cash flow apart from the initial outlay of 8 million naira and the scrap value, which of course we are going to consider later. So if that is the case, we need to determine the profit. So I will then add up all the numbers together. When you add up, you have 1610. We have 4614. We also have 4877. We have 5154. That's the profit. Immediately after profit, remember we are following a format. The same format you use to calculate your net present value is the same you are going to use to calculate the APV. Therefore, immediately after profit, you need to calculate tax. I will then go to the question, what is the tax rate? Okay, what's the tax rate that the company will pay? Examiner has told us, when you look at note number 5, we are told that the company tax rate is 30% and the company will pay tax in the same year profit is earned. Therefore, I will then say, I will bring out my calculator. I want to calculate tax. I want to pay tax on the profit. The first profit is 4614. Then multiply by 0.3 equal 1384. Here is 1384. All right, that's 1384. The next one is 4877. 4877 multiplied by 0.3. That will give us 1463. That's the 1463 you have there. And the third one is 5154 multiplied by 0.3 equal to 1546. That's 1546 we have in the third year. So once we have this, immediately after taxation, you need to consider tax saved on capital allowance. So let us go and calculate workings on tax saved on capital allowance. How do I calculate my tax saved on capital allowance? I will then go to the question, where do I have information on capital allowance? Information number 6 is the capital allowance. So examiner told us that the machine we are transmitting down value of 25%. So capital allowance rate is 25% on reducing balance basis. Okay, and remember, capital allowance will always follow the pattern of that tax liability. So if that is the case, capital allowance is 25% per annum and on a reducing balance basis. So let's go and calculate our capital allowance. So to get the tax saved on capital allowance, you're already familiar with this format. Okay, to calculate the tax saved on capital allowance, the first thing, because it's on a reducing balance basis, the initial cost of the asset is 8 million naira. Then, of course, annual allowance rate is 25% on a reducing balance basis. So 25% on 8 million naira will give us 2,000. Difference between 2,000 and 8,000 is 6,000. So that 6,000 is the tax written down value at the end of year one. I will then move to year two. 25% on 6 million will give me 1,500. All right. The difference is tax written down value of 4,500 at the end of year two. Then this asset has 3 years life. The asset has 3 years life. Therefore, I will find the difference between, since year three is the final year, therefore I need to compare the tax return value from the preceding year of 4,500 with the scrap value of 1,200. When you look at the additional information about one, we are told that the scrap value of the asset is 1.2 million naira. Okay, so if that is the case, I would then say tax return value at the end of year two minus 1,200, then that will give me 3,300. So when the tax return value from the preceding year is higher than the sales proceed of 1,200, the difference is called balancing allowance. Okay, balancing allowance. So for me to now get the tax saved on capital allowance, I need to multiply the company tax rates on the capital allowance computed. Okay, therefore, I will then bring out my calculator. How do I get my tax saved? I will say capital allowance of 2,000 for year one multiplied by 0.3, which is company tax rate. That will give me 600. That's how we got the first 600. Then the capital allowance of year two, 1,500 multiplied by company tax rate of 30%. That's 450. That's how we got the 450. Then in the third year, we have balancing allowance of 3,300. Then multiplied by the company tax rate of 30%. That's how we got the 990. Okay, when you add up, for example, if you want to compare, if you want to confirm that what you have done is correct, because you cannot charge more than the capital, you cannot claim more than the capital allowance you are supposed to claim. So for you to know whether you are correct, you can add up all the capital allowance, all the tax saved on capital allowance, you can add them together. So to confirm if what you have done is correct. So 990 plus 1,050. So the company is supposed to claim capital allowance of 2,040,000 naira. How do you confirm the correctness of this number? So the total tax saved to claim supposed to be equal to the cost of the assets minus the scrap value multiplied by the company tax rate. Okay, multiplied by the company tax rate. Therefore, the total tax saved will then be equal to the cost of the asset is 8,000 minus scrap value of 600. Okay, minus scrap value of 1,200, rather 1,200. The difference, of course, multiplied by the company tax rates of 30%. Okay, let me rewrite that so that we see everything. Okay, total tax saved is equal to 8,000 minus 1,200 multiplied by 30% company tax rate. So this will be equal to 6,800 multiplied by 0.3 equal to 2040. Our answer here is equal to 2040. So you cannot claim more than the capital allowance you are supposed to claim. That means what we have done is correct. You can see 240 versus 240. So you cannot claim more than that. So at this point, I'll then need to go and post year one, 600, 450, 990. Okay, this is 600, 450, then 990. So that's our working in year three. Then the next one is to consider scrap value. Scrap value will occur at the final year, which is 1,200. Okay. Then you consider initial outlay of 8 million naira. Examiner has told us that there is no working capital. We are not giving working capital in the question, so just ignore. So that's initial outlay is 8 million. At this point, I need to find the net cash flow. Once I have the net cash flow, of course, for year 0, 8 million. Year 1, 3,830,000. Year 2, 3,864,000. Year 3, 5,798,000 is the net cash flow. Once I have the net cash flow, I will keep it on one side. This is the first procedure you need to carry out when you want to calculate base case NPV. The second step you are supposed to do now is to go and calculate the cost of equity on gear. Therefore, now that I want to calculate the cost of equity on gear, how do I do it? I will go to the question where I have information of a proxy company. That is information number 8. So we are told that Xterra PSC is a company that is involved in snowball manufacture. It has an average equity beta of 1.19. Because the examiner has given us equity beta of a proxy of 1.9, then we need to ungear the beta because we have debt equity proportion of 30%. You ungear, so you identify the beta, which is of course 1.19. You ungear it, then you calculate cost of equity ungear. So let's go and do working for that. Okay, that will be working number 4. Okay, calculating cost of equity ungear. So this will be calculated using the proxy information. Thus, since equity beta of a proxy is given, you are given equity beta of a proxy, the cost of equity ungear will be computed as follows. Identify the proxy beta. We have done that, which is 1.19. Okay, we need to ungear now. We ungear because the beta of 1.9 is geared. It is geared because the company has debt of 30%, has debt equity ratio of 30%. So now the proxy beta of 1.9 is geared because Xterra has debt in its capital structure. Therefore, we need to ungear the beta to remove financial risk. Since debt beta is risk-free, the formula below will be used. Okay. So like I said, if you use this formula, of course, BA is the beta asset, BEG is the beta equity of a gear, E is equity value of a proxy, D is debt value of a proxy, T is the tax rate of the proxy company. So when you slot it in the formula, our answer is 0.92. If I don't want to use this formula, I can also say beta asset equal to beta equity of a gear multiplied by 1 divided by 1 plus 1 minus tax multiplied by debt equity proportion of the proxy company. So beta equity of a gear is 1.19 multiplied by 1 divided by 1 plus the tax rate of a proxy company is, of course, examiner did not give us a tax rate for the proxy company. It means that both Tripatoli and the Xterra, both the proxy company and the main company have the same tax rate. Okay, they both have the same tax rate. Therefore, let's go and do that. So I would then say, so tax rate is 30%. That means we are supposed to account for 70%. Then, of course, multiply by debt equity ratio. Debt is 30%. Equity will be 70% according to the question. Therefore, bring out your calculator. Let's do it once and for all. In this case, I would then say 30 divided by 70 equal, then multiply by 0.7 equal, plus 1 equal, that's 1.3. Therefore, 1 divided by 1.3 equal, multiply by 1.19 equal, that's 0.915, that's 0.92. Here is equal to 0.92, which is the same thing. Whether you use this formula, or use the other one, you are supposed to get the same answer. Now, so that is that. Now that I have I've done step 2. Step 3 now is to calculate cost of equity on gear. How do you then calculate the cost of equity on gear? Therefore, of course, just use capping. All right. So this is the formula for calculating capping. You're already familiar with that. And our final answer is 16%. So the cost of equity on gear is 16%. So at this point, I need to then discount. The net cash flow using 16%. So when you, of course, for year 1, for example, I will say 1.16 raised to power 1 minus equal, that's 0.862. That's how we got this 0.862. Again, for year 2, 1.16 raised to power 2 minus equal 0.743. That's how we got this number. Then step 3, year 3, 1.16 raised to power 3 minus equal, that's 0.641. That's how we got this number. By the time you multiply, this will give you 8,3301,2871,3717. So you add up for us to get our base case NPV, which is the fourth step. Okay, the first step is to calculate the base case NPV, which represents the difference between positive present value and the negative present value. So you are supposed to add up all the positive present value together, then you now less the negative present value. So the difference is 1889. So that is our base case NPV. So you keep this base case NPV on one side, then you now do the PV of financing effect. So let's calculate the PV of financing effect. All right. Okay. So the next we want to do now is to solve for PV of financing effect cash flow. Like I explained earlier on, the first thing first you need to do is to ascertain whether you want to use cost of borrowing or risk rate of return as the discount rate for the financing effect cash flow. Then step 2, you must ascertain if you want to use net finance required or gross finance required for the cash flow arising from subsidized loan and tax saved on interest. If examiner is not specific on which one to use, always use the gross finance required. Then, of course, those are preliminary procedures that you need to carry out. The main procedure for calculating the present value of financing effect cash flow is 1, to calculate the PV of issue cost, then 2, PV of net subsidy, then 3, PV of tax saved on interest. Then once that is done, you then move to step 4, which is to calculate the PV of financing effect cash flows. So quickly, let's go through that together. Okay. Now, we want to calculate the PV of present value. I want to calculate the present value of financing effect cash flow. So the first thing first, I will go to the question. If I'm given issue cost, of course, we have identified from the question that there is an issue cost. So I will then go to where I have information on issue cost in the question. Okay. Yes, we are told that if you look at this paragraph, examiner has told us that there is an issue cost. Okay, there is an issue cost here. The issue costs are 4% of the gross equity issued and 1.5% of the gross debt issues. So there is an issue cost. Therefore, we need to calculate the PV of issue cost. But the first thing first, before we do this, we need to ascertain whether we want to use cost of borrowing or the risk-free rate of return, or whether we want to use the gross finance required. So if that is the case, I will then come here. I need to go and calculate the gross finance required. All right. First thing first, I will calculate the gross finance required. Now, so again, remember what I told you. you need to first of all ascertain whether you want to use cost of borrowing or the risk-free rate of return. So according to the question, the cost of borrowing, let's determine the cost of borrowing from the question. Okay, now we are told that assume that the net risk-free rate and that the risk-free rate of return is 10%. So risk-free rate of return is 10%. Cost of borrowing in this question, let's see if we are given cost of borrowing. There's nothing like interest here. There's nothing like interest in this question. Therefore, if we are not given cost of borrowing, then we may likely assume the risk-free rate of return as the cost of as our discount rate for financing effect cash flow. So we are going to assume the risk-free rate of return for to discount the cash flow arising from the financing. Okay, so if that is the case, let's go and do that. All right, now, so like I said, we are going to assume the risk-free rate of return. Okay, we assume risk-free rate of return as a cost of capital or discount rate for financing effect cash flow. Okay, then in this working number 5, so we want to calculate the gross finance required. So to get the gross finance required, like I explained, it must be net finance required divided by 1 minus issue cost rates. So I would then you are going to do this separately for equity and debt. All right, we are going to do it separately for equity and debt. Examiner has told us that according to the question, we are told that Tripatoli raised the finance through a mix of equity and debt. Therefore, the initial investment of 8 million naira, which is the net amount in this case, because when the company is raising the money from the beginning, this 8 million is what the company will receive. So something has been deducted from the source. That is what is called the issue cost rate. So this 8 million naira, if we are given the working capital, so it will be the initial outlay plus working capital. That's the net finance. So since we are not given net working capital, you ignore that. Therefore, I need to get the gross finance required. However, this net finance required of 8 million, examiner has told us in the question that 80% is for equity. Look at debt debenture redeemable in 3 years' time is 40%. Okay, equity is 60%. Therefore, all I need to do from the 8 million naira, before I gross it up, I need to determine the proportion attributable to equity, the proportion attributable to debt. So when you take 80% of 8 million, that's 4.8. 40% of 8 million will give us 3.2. Then I will now find the gross finance required for equity, gross finance required for debt. So when I gross it up, examiner has told us that the issue cost rate on equity is 4%. Look at issue costs are 4% of the gross equity issued, then 1.5% of the gross debt issued, and tax is not debt issue costs are tax deductible. So which means that on the debt of this 40%, I need to calculate tax saved on issue cost amount for year 1 only. So if that is the case, let's quickly gross it up. So when you gross it, the 4.8 million divided by 1.4, that's 0.96. I got gross amount of 5 million for equity. For the debt, the issue cost rate is 1.5%. When you do the calculation, we have 3,248,731. Okay, so that's the gross amount. Now that I have the gross amount, we've already ascertained that we are going to use the rate of return of 10% because, again, look at the statement. The risk-free rate of return of 10% has been assumed for discounting the finance effect cash flow since, of course, debt cost of borrowing is not given. We are not given interest rates for the borrowing rate. So in that case, we are assuming the risk-free rate of return of 10%. Then, so if that is the case, I need to go ahead and calculate. I need to calculate the present value of issue cost amount in year 0 for equity and debt, then in year 1 only for debt. So let's do the calculation. Now, so the next thing I need to do now, I want to calculate present value of issue costs amount on equity. Like I explained, so to get the present value of issue cost amount, all you need to, since we have calculated the gross finance required. The gross finance required is 5 million naira. Okay, the gross finance required is 5 million naira. That's the 5 million naira here. So all I need to do now is to calculate the issue cost amount on equity. The issue cost amount on equity will be the gross finance required multiplied by issue cost rate of 4%. So I will just say 5 million naira. Our figures are just say 5 million naira multiplied by 0.04. That will give us 200,000 naira. So that's the 200,000 naira you are seeing there. Figures are in thousands. Okay, that's the PV, of course. PV of issue cost amount on equity in year 0. I will do the same thing. PV of issue cost amount on debt for year 0 only. Again, I will go and pick the gross finance required on debt, which is 3 million, which is 3,3248,731 multiplied by 0.015, because 1.5% is the issue cost rate on debt. So that gave us 48,731. 48,731. So 48,731. When you round it up, that's 49. That's how we arrive at the 49. Then the last step I'm going to do under the calculation of PV of issue cost amount, I need to calculate tax saved or tax benefit on issue cost amount on debt in year 1 only. So to do this, since my cost of capital, my discount rate for financing effect cash flow is 10%, therefore I need to calculate the issue cost amount on debt, which is 49. Okay, which is 49. Then I will multiply company tax rate on it. The company tax rate is 30%. Then I need to go and calculate discount factor for year 1 only at 10%. So 10% discount factor is 0.909. That is 1.1 raised to power 1 minus equal. That's 0.909. That's how we got the 0.909 you have here. By the time you multiply, you have 13. So 200,000 plus 49,000, that's 249,000 minus 13. So that will give us 237. Okay, that will give us 237. Rounding, 237,000 naira. So this is PV of issue cost amount. Okay, I will keep it on one side. I need to go back to the question. Am I given subsidized loan? According to the question, there is nothing like subsidy. We are not given subsidy in the question. Since there is no subsidy, I will just ignore. Okay. Remember, there is no tax deductible on equity. You cannot claim tax. You can't claim tax benefits on equity. It is only on debt that you can claim tax benefits. So, and that's why we calculated only on the debt, but nothing on the equity. Okay. So what else? Now, the next, since we are not given subsidized loan, there's no subsidy. So we need to calculate the present value of tax saved on interest. So to get the present value of tax saved on interest, the first thing we need to do is to accumulate all interest elements. We are going to have only one interest, which is on the debt. Okay, we are going to calculate interest on the debt. The debt amount, the gross amount of the debt is 32,409. Look at 3 million. Okay, it's 3,3249. Let me go back there. This is 3249, rounding 3249. Our figures are in thousands. 3249. So since the gross amount on debt is 3249, then you multiply tax rate of 30% of that. That will give us tax saved on interest. Before that, so yes. We have accumulated all interest elements, And the interest on the debt is 10%. So that's how we arrive at this 325. Okay, the interest on that debt, the gross amount of the debt is 3249. So interest expense on the debt is 10%. So 10% of 3249 will give us 325. Then you now calculate tax saved on interest. The tax saved on interest is the total interest multiplied by the tax company tax rates. So 30% of 325 will give us 98. All right, will give us 98. Therefore, the last step under this is to calculate the present value of the tax saved on interest, which is tax saved multiplied by annuity factor. So I need to go and calculate annuity factor. So annuity factor for year 1 to 3, the useful life of this project is 3 years. So annuity factor of year 1 to 3 will then be equal to 1.1. The cost of capital is 10%. So 1.1 raised to power 3 minus equal, okay, that will just say minus 1 equal divided by 0.1 equal, that's 2.487. That's how we got this 2.487. So 2.487 multiplied by 98 will give us 244. Therefore, the PV of tax saved on interest is 244,000. Now that I've calculated the PV of issue cost and the PV of tax saved on interest, then the next thing we need to do is to go and calculate the adjusted present value. Okay, so we need to calculate the adjusted present value. All right, so how do I calculate my adjusted present value? Very simple. So I will then come here to get my APV. Since I've already calculated the PV of issue cost to be 237, I've also calculated the PV of tax saved on interest to be 244. So define the difference. So we have PV of financing effect cash flow to be 7 naira. Okay, to be 7 naira. Therefore, the difference of 7 naira, we are going to add it to the base case NPV of 1889. So the final step is to calculate the adjusted present value, which is base case NPV plus minus PV of financing effect cash flow. Therefore, the base case NPV we got 1889. Okay, that's the 1889 here. Then with the PV of financing effects, we got 7. That's the 7 here. So you add the two together, that's 1896. Therefore, the project is financially viable. Take into consideration the positive APV of 1896, okay, of 1,896,000. Okay, therefore the project should be accepted. That's it. That's it. That's how to calculate the adjusted present value. So after this, so let's have one more illustration. Let's have one more illustration, and that will be end of the adjusted present value. Let me rewrite this one. Okay, total tax saved. All right, so let's have one more illustration. So okay, let's have this particular illustration number 2. Let's have this illustration number 2. Okay, Traposca PLC is a Nigerian company based in Kaduna. The company is currently quoted on the Nigeria Stock Exchange, but only has a small number of shareholders. Its directors collectively own 45% of the equity share capital. The company is into production of household electrical goods. At the recent board meeting, a strategic decision was taken to diversify operations and make a major investment to producing office equipment. The details of the investment are given below. Information number 1. A feasibility study was carried out at a cost of 10 million naira to identify a suitable location for the factory. The consultant has submitted his invoice for the job done. The invoice amount is due for payment. This particular information is a sunk cost. Okay, that's a sunk cost. That feasibility study cost of 10 million naira is a sunk cost. It's irrelevant, irrespective of when the payment will be paid. Remember, relevant cash flow must relate to the future. So this 10 million naira the activity, the feasibility study has already been conducted. Therefore, it is a past cost, it's a sunk cost, irrelevant, ignore. Number 2, the new investment is being appraised over a 4-year time horizon. That means the useful life of the project is 4 years. Okay, it's 4 years. Revenues from the new investment are uncertain, and Traposka's finance director has prepared what she regards as conservative forecast. Okay, so here is the useful life to be 4 years. Move on. Number 3, she estimates that the project will generate annual revenue of 200 million naira in current value terms, growing by 8% per annum. No inflationary pressure is anticipated after year 4 because of the current government economic interventions. So here is sales, information on sales is on that bullet points or additional information. Number 3, so our revenue, annual revenue is 200 million naira. Number 4, currently, the production costs are estimated to be 150 million naira, and this will be affected by price level changes at the rate of 5% for the next 4 years. Okay, inflation rates. The following are the details of the production cost. So we have a production cost that is made up of all these line items, and it is worth 150 million naira. So examiner, you have the production cost has been breaking down into all of this. Direct material is relevant. Direct labor is relevant. Variable manufacturing overhead is relevant. Direct selling cost is relevant. Fixed selling cost is relevant. Any selling expenses incurred, whether variable or fixed, is relevant. Fixed manufacturing overhead. Since there is no additional information on the fixed manufacturing overhead, ignore it. Now, there's an additional information examiner has told us. So we are told that the fixed manufacturing overheads will be incurred irrespective of the decision taken on the project, meaning that it will not change. Since your fixed cost will not change, then therefore, it is irrelevant. You ignore it. So out of the 150 million for production cost, so that means only 112,000 is what we are going to consider. Let me do the calculation. So 150 million minus 38, that's 112. So production cost equal to 150 minus 38. So only 112. Let me write that. Only 112 million will be considered as relevant production cost. Let's move to the next one. Okay, the office equipment, when completed, will be kept in an unused factory space within the factory. The company has been trying to rent out this idle space in the last 2 years. Luckily, a neighboring business has approached the company and is willing to pay 30 million naira in the first year, and this is expected to increase by 4% per annum subsequently. This is what is called opportunity cost. Okay, we are told that the office equipment, when completed, will be kept in an unused factory space. Even though the company has been trying to let out this factory space for the past 2 years, they've not seen a tenant that will rent up the place, but they're now saying that, okay, luckily, a neighboring business has approached the company and is willing to pay 30 million naira in the first year. So this is an opportunity cost. This is opportunity cost of 30 million naira per annum. Okay, at opportunity cost of 30 million naira. So examiner has told us in the first year, that means subsequently you are going to grow it by 4%. Okay, for the next 3 years, you grow it by 4% for the next 3 years, because the useful life of this project is 4 years. Next item, the new investments will require immediate expenditure on facilities of 200 million naira. That's initial outlay. This information here is initial outlay of 200 million naira. Tax allowable depreciation will be available on the new investment at an annual rate of 25% on reducing balancing basis. Capital allowance is also here. Capital allowance is 25% on reducing balance basis. Number 7, it can be assumed that there will either be a balancing allowance or balancing charge in the final year of the appraisal. The finance director believes the facility will remain viable after 4 years, and therefore a realizable value of 15 million naira can be assumed at the end of the appraisal. So scrap value or realizable value of 15 million naira is on that paragraph. Next item. The new facility will also require an immediate initial investment in working capital of 15% on the first year revenue. Therefore, we have working capital information here on revenue, 15%. Okay, this will increase by 3% for the next 3 years, and any working capital at the start of the year 4 will be assumed to be released at the end of the project, at the end of the appraisal period. So number 9, the company's tax rate is 30% per annum. Here is tax rates. Payable in arrears, so 1 year lag. Number 10, Traposca has been considering 2 choices for financing the entire capital investment of 200 million naira for the facilities. Number 1, information under that. A subsidized loan from the state government loan scheme is available, with a loan repayable at the end of 4 years. Issue cost of 4% of the gross finance will be payable. Interest will be payable at the rate of 100 basis points below the treasury rate of return of 3.5%. So here I can see subsidy. Information of subsidy is on that paragraph. To enjoy the benefit of the loan scheme, Traposca will have to fulfill various conditions, including locating the facility in a remote part of Kaduna to create employment for the local community. Okay, so still talking about the subsidy. All right. Number 2, convertible loan notes with the subscribers for the notes, including some of Traposca's directors. The loan notes will have issue cost of 4% of the gross finance. If not converted, the loan notes will be redeemed in 6 years' time. Interest will be payable at 5%, which is Traposca's normal cost of borrowing. Conversion will take place at an effective price of 3 naira 50 kobo per share. Okay. However, the loan note holders to enforce redemption at any time from the start of year 3 if Traposca's share price fell below 1 naira 50 kobo per share. Traposca's current share price is 3 naira per share. Issue cost for the subsidized loan and convertible loan notes will be paid out of available cash reserves. Issue costs are not allowable as a tax deductible expense. Okay, that's a very big information, a vital information we need to consider. There is no tax benefits in year 1 when you are calculating issue costs on the debt. Okay. In the initial discussion, the majority of the board favored using the subsidized loan. The appraisal of the investment will be prepared on the basis that this method of finance will be used. Okay, the appraiser of the investment should be prepared on the basis that this method of finance will be used. Okay. However, the chairman argued strongly in favor of the convertible loan note, as in his view, operating costs will be lower if Traposca does not have to fulfill the condition laid down by the government of Kaduna. Traposca's finance director is skeptical, however, about whether the other shareholders will approve the issue of the convertible loan note on the terms suggested. The directors will decide which method of finance to use at the next board meeting. Okay, but the information we have here is very vital, because no, not that one, in this place, in this paragraph, because we are told that the majority of the board favored using the subsidized loan. The appraisal of the investment should be prepared on the basis that this method of finance will be used. That is, you should use subsidized loan, okay, instead of convertible loan notes. Number 10, Genzo PLC is a large manufacturing of office equipment in Kaduna with a geared cost of equity of 10.5% and pre-tax cost of debt of 5.4%. The capital structure of Genzo PLC comprises of 225 million naira, 6% irredeemable bond trading at 107 naira per unit, and 125 million naira ordinary shares of 1 naira. 125 million ordinary shares of 1 naira trading at 3 naira 20 kobo per share. Genzo PLC also pays tax at the rate of 30% per annum on its taxable profit. This is information of a proxy. Okay, that's information of a proxy. What else? So you are required to evaluate the financial viability of the project on the basis that the project is financed, by the subsidized loan. Show all relevant calculation. B, state all relevant assumptions. C, advise whether the project should be accepted or not. You can see that in this question, in number A requirements, which carries the highest mark, you have to evaluate the financial viability of the project on the basis that the project is financed by the subsidized loan. In this case, which method are you going to use to appraise the project? There is nothing different. There is no difference between NPV and APV as far as this question is concerned, because the same way NPV question is structured is the same way this question is also structured. Therefore, what are you supposed to do? How do you know you are going to use adjusted present value? Of course, because in the question you are given issue cost. You are given subsidized loan. So you need nobody to tell you that you are supposed to use adjusted present value, because you don't NPV does not consider itself with subsidy or issue cost. So it is only adjusted present value that make use of issue cost. So if that is the case, let's solve the question quickly without wasting more time. Right? So based on the solution we have prepared here, of course, this is what we want to do. Again, the first thing first you need to do is to calculate the base case NPV. You calculate the PV of financing effect cash flow. You calculate the APV, then you advise. However, like I've explained to you, how do you know that you are going to use adjusted present value? So look at the financial viability of the project will be determined using the adjusted present value technique. Since Traposca PLC is diversifying into the production of office equipment, and particularly because issue cost and subsidized loans are provided in the question, therefore, we should use adjusted present value. So let's calculate the base case NPV. I will then go to the question. What I have, if I'm given revenue, go and look for the information where we have noted information on revenue. All right. So this is where information number 3 is where we have the revenue. And we are told that this project will generate annual revenue of 200 million naira in current value terms, growing at 8%. So there's an inflation of 8% on the revenue of 200 million. So let us go and do working for that first. Okay, we want to calculate working for revenue. Now, remember that 200 million naira is in current value terms. Because it's in current value term, inflation should start from year 1. So how do you then calculate your inflation? How do you inflate the revenue of 200 million? Therefore, I would then say inflation rate is 8%. So 1.08 multiplied by the revenue of 200 million in current value terms. That will give me 216. That's the 216 you have in the first year. Then multiply by 1.08. That produces 233. That's 233 you have in second year. Multiply by 1.08. That produces 252. That's what you have in year 3. Remember, this project has 4 years useful life. Then multiply by 1.08. Sorry, let me do that again. 1.08. That's 272. That's how we got to 272. So then we then go and post. So let's go and post for the revenue. So that's the revenue here, working number 1. That's working number 1. That's the revenue. The next thing I need to do now, I will then go back. Am I given variable cost? Examiner has listed the production cost. We are given production cost, okay, which is note number 4 is production cost. Under the production cost, of course, we have all those variable costs like direct material, direct labor, variable manufacturing overhead, direct expenses. We are not, of course, we are given direct selling costs, then fixed selling costs. In any case, add up all of that together. That will give us 112 million. We've already done this. So the fixed manufacturing overhead is irrelevant, and that's why we ignore it. So let's go ahead and determine that. Let's go and inflate. Then again, what's the inflation rate on the production cost? Okay. We are now told that in that note number 4, we are told that the inflation, we are told that the production costs will be affected by price level changes. Price level changes is the same thing as inflation at the rate of 5% for the next 4 years. So let us go and grow the 112 million naira production cost. Okay, so the production cost, like I said, is 150 million minus 38 million. That's 112 million. So inflation rate is 5%. Therefore, I will say 1.05 multiplied by 112. That's 118. So that's 118 you have in the first year. Multiplied by 1.05. That's 123 you have in year 2. Okay. Multiplied by 1.05. That's 130 you have in year 3. Multiplied by 1.05. That's 136 you have in year 4. Then let us go and post. This is the way you'll be doing it one by one. You don't wait until you finish your working before you post. That's the second working, and we have posted it. All right. Then we then go back to the question: is there any other relevant cash flows? Yes, there are other relevant cash flow, because in the question we identify opportunity cost. So in note number 4, we are told that there is an office equipment when completed. This office equipment will be kept in an unused factory space within the factory. The company has been trying to let out the idle space in the last two years. Luckily, a neighboring business has approached the company and is willing to pay 30 million naira in the first year. There is no way the company will be able to earn this 30 million naira, because that space will be used to keep the office equipment. Therefore, it's a benefit forgone. The company cannot earn the 30 million naira, and that is what is called opportunity cost. And we are told that this 30 million naira is in the first year. Therefore, we need to inflate for the next 2-3 years. So, and the inflation rate we are told is 4%. So quickly, let us go and calculate opportunity cost for other years. That will take us to working number 3. So opportunity cost on rent. So the first year rent is 30 million naira. That's the 30 million you are seeing here. Okay. Then, of course, inflation rate is 4%. Therefore, 1.04 multiplied by 30 million. That's 31. Multiplied by 1.04 equal 32. That's what you have in year 3. Multiplied by 1.04 equal 34. That's what you have in the year 4. So let us go and post the opportunity cost. Opportunity cost is all of this. That's how we did it. Then let's go back to the question. If there are other relevant cash flows that we need to consider. Of course, when I was reading it, there is no other one. The only one we have is the sunk cost, which of course the feasibility study report is a past cost. Therefore, that one is irrelevant. There is no other cash flow again. So let's move to the next one. Now, the next thing we need to do now is to determine profit, taxable profit. So we add up all the number for year 1, 216 minus 118 minus 30 will give us 68. Year 2, 233 minus 123 minus 31 will give us 79. 252 minus 130 minus 32 will give us 90. 272 minus 36 minus 34 will give us 102. So at this point, we need to pay tax. So for the company to be able to pay the tax liability, we need to check from the question, when is the company going to pay tax? Is tax being paid in arrears or in the current year? So let's go to the question and confirm how the company will pay tax. So we have told that the company's tax rate is 30% per annum payable in arrears. So 1 year lag between when the company will pay tax. So if that is the case, let's go and calculate our tax liability. Therefore, tax rate is 30%. Therefore, the profit of year 1 will be taxed in year 2. The profit of year 2 will be taxed in year 3. The profit of year 3 will be taxed in year 4. The profit of year 4 will be taxed in year 5. That is why this project has extended by 1 year because of tax purposes. So let us multiply. I will then say 68 million multiplied by 0.3. Tax rate is 30%. That's 20. So that's the 20 you are seeing. You are not going to put the 20 million in year 1 because tax is paid 1 year after. So that's why you are seeing the 20 million here in year 2. I will do the same thing for the second year profit of 79 multiplied by 0.3. So that's what gives us 24. That's this 24 we know you are not going to put it in year 2. Rather, it will be 1 year after, which is year 3. Then the profit of year 3, which is 90 million. So 90 million multiplied by 0.3. That gave us 27. That 27 will be paid in 1 year after, which is in year 4. Then the profit of year 4 of 102 multiplied by 0.3, that's 31. That 31 will be paid in the following year, which is year 5 in this case. Okay, which is year 5. So that's why we are seeing 31 here in year 5. Okay, so after that, so we need to consider tax saved on capital allowance. Remember, we are following a format. So immediately after tax liability, we need to consider tax saved on capital allowance. I will then go to the question, how am I going to pay? How am I going to claim capital allowance? I think I noted this somewhere when I was reading. Yes, in this bullet point number 6. Okay, in this bullet point number 6, that's where you have information on on the capital allowance. We are told that the new investment will require immediate expenditure on facility of 200 million naira. That 200 million naira is the cost of the facility. Tax allowable depreciation will be available on the new investment at an annual rate of 25% on a reducing balance basis. So let us calculate tax saved on capital allowance on that. So I will then go to working number 4 now. Okay, we want to calculate tax saved on capital allowance. The useful life of the project is 4 years. Therefore, year 0, you have the cost of the project, which is 200 million. Okay, then I will now multiply 25 to get the capital allowance in the first year. 25% of the 12 million of 200 million, that's 15 million. The difference is 150, which represents the tax written down value at the end of year 1. Okay, then 25% of 150. Let's use calculator. 25% of 150.25 multiplied by 150 equal, that's 38. Okay, that's 38. So that's how you see this 38 here. All right, so 38 minus 150, that will give us 112. Okay, 150 minus 38 will give us 112. All right, so that's the tax written value at the end of year 2. We then move to year 3. 25% of 112. Okay, 25% 0.25 multiplied by 112 equal, that's 28. All right, that's 28. 28 minus 112 will give us 84. All right, then of course the final year is year 4. So the tax written down value of 84 minus sales proceed of 15. Let's go and confirm the sales proceed, whether it is 15. I think I noted it down somewhere. Yes, the salvage value we are told that therefore a realizable value of 15 million can be assumed at the end of the appraisal period. So the scrap value is 15 million naira. So if that is the case, I need to minus. Okay, so 84 minus 15 will give us 69. So that's since the tax written value from the preceding year is higher than the sales proceed at disposal, then the balance is the difference is called balancing allowance. So we have capital allowance of 50 million in the first year. To get the tax saved on the capital allowance, you are going to multiply the company tax rate of 30% on 50 million. Therefore, 50 multiplied by 0.3. Okay, is it 0.3? Yeah, 0.3. That's 15. That's 15. That's how we got this 15. Then the next one, the next capital allowance is 38. Therefore, 38 multiplied by 0.3 will give us 11. 28 multiplied by 0.3 will give us 8. Let me confirm that. 28 multiplied by 0.3, that's 8. Okay, that's 8. The next one, of course, the last one is balancing allowance of 69. Therefore, 69 multiplied by 0.3 equal, that's 21. Okay, that's how we got this 21. So when you add up everything, if you want to confirm the total capital allowance claim, you can add up everything. So by saying that the first one is 15 plus the second one, which is 8, okay, plus 8, sorry, 11 plus 11 plus 8, that's 19. Okay, let's do this way. 15 plus 11, that's 26. 26 plus 8, that's 34. 34 plus 21, that's 55. So I can then confirm whether my total capital allowance claim is not more than what I'm supposed to claim. So to do this, the total tax saved will then be equal to the cost of the project minus the scrap value multiplied by the company tax rates. Okay, so the cost of the project is 200 million. Let me confirm that. Yes, it's 200 million. So I would then say 200. The total of this one is 55. So 200 million minus scrap value of 15 million multiplied by a company tax rate of 30%. So I should have the same thing as 55. So bring out the calculator to say 200 minus 15 equal, sorry, there's a mistake there. 200 minus 15 equal, then multiply by 0.3 equal, that's 55. Okay, that's 55. So that's how we arrive. So everything must be equal at the end of the day. You can't claim more than what you are supposed to claim. So that's for that. Now that I've calculated my tax saved on capital allowance, let's go and post. Okay. So these are the tax saved on capital allowance posted there. Then I will now include the realizable value, the scrap value at year 4, which is 15 million. All right. Then initial outlay in year 0 is 200 million. Working capital is now, examiner told us that there is a working capital of 15% on annual revenue. So let's go to where you have information on the working capital. In note number 8, you are told that the new facility will also require an immediate initial investment in working capital of 15% on the first year revenue. This will increase by 3% for the next 3 years, and any working capital at the start of year 4 will be assumed to be released at the end of the appraisal period. So there's a working capital of 15% on revenue. So let's go and work it out. So now the revenue in the first year Revenue in the first year is 216 million. This is it. 216 million. So 15% on 216 million. Okay. 15% on 216 million will be equal to, let's do the working. 216 multiplied by 0.15 equal, that's 32. So that's how we arrive at this 32 you see in the first year. All right, not that one. The 32 you have here. Therefore, we're now told that subsequently for the next 3 years, it will grow by 3%. Therefore, 32 multiplied by 1.03 equal, that's 33. Okay, that's how you arrive at this 33. Then you multiply by 1.03 equal, that's 34. That's the 34 you have here. Then again, multiply by 1.03 equal, that's 35. That's how we arrive at this one number there. So the highest working capital now is 35. It cannot be more than 35 because that's the highest number that you have. You can see that the working capital has grown from 32 to 35. Therefore, you need to find the incremental working capital. For the first year is 32. So 32 minus 33 is 1. 33 minus 34 is 1. 34 minus 35 is 1. When you add up all the working capital, it's 35, which is, of course, consistent with the highest working capital that you have. Therefore, how do you treat it? Remember, working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. The working capital of year 1 will be treated as cash outflow in year 0. The working capital of year 2 of 1 will be treated as cash outflow in year 2, treated as cash outflow in year 1. The working capital of year 3 of 1 will be treated as cash outflow in year 2. The one of year 4, cash outflow in year 3. Then at the end of the useful life, which is year 4, you need to recover the entire working capital of 35. At the end of the day, everything will zero out. So let us go and post incremental working capital. So when you list everything, that's the incremental working capital. At this point, we need to find the net cash flow. Remember, we are still calculating base case NPV. So this will be 232, 67, 74, 77, 133, then 10. Then after this, remember what I told you. Your tax saver on capital allowance must follow the pattern of your tax liability. That's why it is consistent 1 year lag with the tax liability. Now, remember when you are calculating the base case NPV, the first thing first is to calculate the net cash flow. Then the second step is to calculate cost of equity on gear. So let us go ahead and calculate the cost of equity on gear. I will then go back to the question, how am I going to calculate the cost of equity on gear? So to do that, I need the information of a proxy. I will go to the section of the question where I have information on proxy company. So the proxy company here is Genzo PLC. I've already noted that when I was reading it. It's Genzo PLC. Therefore, I will need to check Genzo PLC. Do you have beta, or you have cost of equity, or you have WACC? According to the question, examiner has told us that Genzo PLC is a large manufacturer of FX equipment in Kaduna with a gear cost of equity of 10.5%. Examiner has told us that it is cost of equity that Genzo has. So if Genzo has cost of equity, then I need to calculate cost of equity on gear using Miller and Modigliani formula. Therefore, let us go and calculate cost of equity using Miller and Modigliani. That will be working number 6. Okay, that will be working number 6. Okay, so we use this one as working number 6. All right, so we want to calculate cost of equity on gear. Since cost of equity on gear of a gear is given, the cost of equity will be computed using the Miller and Modigliani formula as shown below. You already know this formula. That's the formula for Miller and Modigliani. KE is cost of equity of a gear. In this case, that will be 10.5%. Okay, that will be 10.5%. Then, of course, cost of equity on gear is what you are looking for, so it's unknown. Then KD, cost of debt. Cost of debt, I will then go back to the question, what is the cost of borrowing for Genzo PSC? Okay, let's identify cost of borrowing for Genzo PSC. So we're now told that pre-tax cost of debt is the cost of borrowing is 5.4%. Interest rate is 5.4%. So that's that. That's why you are seeing this 5.4 there. That's the 5.4 you are seeing here. Then D, which is debt value. We need to go and calculate debt value. We also calculate equity value. We already know that tax rate is 30% for the proxy company, which is similar to the tax rate of the main company in this case. Then, if that is the case, let's calculate the market value. How do you get market value? That will take us to working number 7. Of course, in this case, in the material is working number 6. So to do this, I want to calculate the market value of equity. Okay, we have already done this under cost of capital, so you know it. However, to get the market value of equity is number of shares multiplied by XDIV share price. Again, in as much as we are not under cost of capital, forget about whether the dividend has been paid or not. We are less concerned with that. Just multiply with share price. So I will then go to the question, what's the number of shares of Genzo PSC? The number of shares of Genzo PSC, we are told that the capital structure of Genzo PSC comprises of 225 million naira 6% irredeemable bonds trading at 107 per unit and 125 million ordinary shares of 1 naira. So the number of shares is 125, trading at 3 naira 20 kobo per share. Therefore, I need to multiply 125 million by 3.2. So that will give me the market value of equity. Okay. Market value of equity. So the value of equity, 125 million multiplied by 3 naira 25 kobo will give us 400 million naira. The market value of the debt is the nominal value multiplied by interest expense divided by 100 naira. Okay, so the nominal value of the debt is 225 million. The market price of the debt is 107 divided by 100. That will give us 241. So I've gotten the debt value to be 241, equity value to be 400. At this point, I'll just slot in into the formula and I will get the final answer is equal to 9%. So the cost of equity on gear is approximately 9%. Okay, it's approximately 9%. Now that I have the cost of equity on gear, I can then proceed to calculating the base case NPV. So the next step I need to do now is to calculate the present value of the base case. Now, I need to first of all go and calculate the discount factor at 9%. So, of course, I get all these numbers. That's the discount factor for each year. That is 1.09. Let me do example for 1.09 raised to power raised to power 1 minus equal, that's 0.917. Okay, 0.917. That's how we got that number. We do for all. The next we need to do is to calculate the present value. 232 multiplied by 1, 232. 67 multiplied by 0.917, 61. You do for everything, then we got the present value. The next we need to do is to calculate the base case NPV, which is the difference between the positive present value and the negative present value. You add up all the positive present value. Okay, you add up all the positive present value. So 61 plus 62 plus 59 plus 94 equal minus 7 minus 232. You get 37. So that 37 million represent the base case NPV. That is one step in calculating the adjusted present value. Step 2 is to calculate the present value of financing effect cash flow. Now, how do I calculate the present value of financing effect cash flow? So the first thing I need to do is to calculate the PV of issue cost. Examiner has told us that we should use net subsidy, then in that case, let us go and calculate present value of issue cost first. Okay, PV of issue cost. Now, remember what I told you. In the calculation of PV of issue cost, you must ascertain whether you want to use cost of borrowing or risk-free rate of return. Okay, you ascertain whether you want to use cost of borrowing or risk-free rate of return, and I advise that you should always use the cost of borrowing, because cost of borrowing will always be higher than the risk-free rate of return. However, the cost of borrowing in this case, okay, I did not indicate it. I didn't indicate it, but again, let's us go and identify the cost of borrowing for Genzo PSC, for the proxy company rather. Okay, so cost of borrowing for the main company. The main company is Traposca. What's the cost of borrowing? So go through the question. Let's identify cost of borrowing. Examiner has told us where you have issue costs. There's a place where we have information on issue costs. We are told that interest will be payable at the rate of 100 basis points. This is subsidy rates. This is subsidy rates, information on subsidy rates. So it will be 100 basis points minus 3.5. That's 2.5. Okay. So we're looking for information on cost of borrowing. Okay. We are told that the loan notes will have issue cost of up. That's not cost of borrowing. The interest will be payable at 5%. Okay. That's on the convertible. So interest rate is 5%. So in that case, I think we've seen what I'm looking for is 5%. Right? It's 5%. But first thing first, you remember what I told you. You must ascertain whether you want to use cost of borrowing or risk-free rate of return. So then, of course, the risk-free rate of return is 3.5%. Okay. So remember what I said. Now, before you begin to do net finance require or gross finance require, the first thing first is for you to ascertain whether you want to use cost of borrowing or risk-free rate of return. So according to the question, the normal borrowing rate, the cost of borrowing is equal to 5%. The risk-free rate of return is equal to 3.5%. So like I advise, always use the cost of borrowing. Also, you also need to calculate the rate of the interest rate on the subsidized loan. The interest rate on the subsidized loan, you have been told it is 100 basis points below the risk-free rate of return. Okay, you are told that interest will be payable at a rate of 100 basis points below the treasury rate. Treasury rate is the same thing as risk-free rate of return. Risk-free rate of return is the rate of return associated with government security, which is 3.5. 100 basis points is 100 divided by 100, that's 1%. So 3.5 minus 1%, that's 2%. So the subsidy rates, the interest rates on subsidized loan is 2.5%. Here will be 3.5% minus 100 divided by 100 basis points, which is equal to 2.5%. So that's for that. Now, the next thing we want to do is to confirm whether we want to use net finance require or gross finance require. And I said, at all time, always use the gross finance require. So to get the gross finance require, It is simply the net finance required divided by 1 minus issue cost rate. And the net finance required is the initial outlay of the project plus the working capital in year 0. When you add the two together, that's 232. You already have in the question. Look at, let's go up there and pick it. The 232 million. This is 232. The initial outlay plus working capital, that's what gave us the 232 million. Okay, that's the net finance required. Now that you have the net finance required, we need to calculate the gross finance required. So 232, the issue cost rate is 4%. Therefore, 1 minus 4% will give us 232 divided by 0.96. That's 232, that's 242 million. So the gross finance required is 242 million. Now, the next thing we want to do, since we are told that the project will be financed with issue cost, examiner has told us that the project will be financed with issue cost. So we are less concerned with debt, since it is going to be financed with issue cost. I've already determined the interest rates on the subsidy. Okay, the subsidy rate is expected to reduce by 100 basis points on the threshold bill rate of return. So that's how we've already determined that the normal borrowing rate is given as cost of debt of 5%. The normal borrowing rates that will be used, the normal borrowing rate is the rate that will be used for discounting the cash flows arising from financing effect. We've already taken that assumption. Then, so I need to calculate the present value of issue cost. We have determined the gross finance required. We have ascertained that we want to use the normal borrowing rate of 5% to discount the cash flow arising from financing. Therefore, the next thing we want to do now is to calculate the present value of issue cost. There is no equity, so I would then say issue cost amount in year 0, which represent the gross finance required. Okay, this is gross finance required. So multiply by issue cost rates. The gross finance required is 232. Okay, that's the gross finance required. This is it, 232 million. Okay, that's the net finance. Oh, there's an error there. It's 242, supposed to be 242, no, not 232. Okay, so it's supposed to be 242. So 242, let's use our calculator. Okay, 242 multiplied by 4%. That will give us a 9.68. That's 9.68. Here is supposed to be 9.68. Let me redo it. So this is supposed to be 242 rather, multiplied by 4%, which is 9.68. Okay, so the PV of issue cost at year 0, of course, all you need to do is to multiply with discount factor at year 0. The cost of capital, the discount rate you are using is 5%, since we are assuming 5% discount rate. Therefore, that means the PV of issue cost in year 0 is 9.68. Examiner has told us that, of course, this number must be in brackets. So examiner has told us that we should assume, okay, that there's no tax benefit in year 1. Let's go back there to pick the information where we are told that there's no tax benefit in year 1. I told you the information is vital. Yes. So in this particular paragraph, you are told that issue costs for the subsidized loan and convertible loan note will be paid out of available cash reserves. Issue costs are not allowable as tax deductible expense. So there is no tax saved on issue cost in year 1. So you ignore it. Okay. So, and that's why we did not calculate tax saved on issue costs. Tax saved on issue costs in year 1. So according to the question, issue costs are not allowable as tax deductible expense. This means that there is no need to calculate the PV of tax relief on issue cost in year 1. So we ignore that. So the next thing I need to do, I will go back to the question, there is subsidy. There is subsidy. Therefore, we've already calculated the gross finance required. Okay, again, the gross finance required is not 232, it's 242. Okay, so the gross finance required is 242. It's 242. All right. So 242. Now, I need to get the proportion of the equity, sorry, a proportion of the subsidy. Examiner has told us that 100% will be, the project will be 100% financed with subsidized loan. So the gross finance required of 242, this is supposed to be 242 million, is expected to be financed entirely by the subsidized loan from the state government. So subsidy amount is entirely 242 million. Okay. Savings on subsidy. In this case, savings will be equal to the interest rates on normal borrowing minus the interest rates on the subsidy. So interest rates on normal borrowing is 5%. Interest rates on the subsidized loan is 2.5. Therefore, saving is 2.5. The next thing we need to do is to calculate the net subsidy. The net subsidy is the subsidy amount multiplied by savings on subsidy, then multiplied by 1 minus tax rates. So here will be 242 multiplied by 2.5. Tax rate is 30%. 1 minus 30% will give us 70%. So what do we get? So that will then be equal to 242 multiplied by savings of 0.025 multiplied by 0.7 equal, that's 4.235. 4.235 is the net subsidy. So here is supposed to be 4.235. Okay, so 4.235, just say 4.24, rounding 4.24. Then PV of net subsidy will then be net subsidy multiplied by annuity factor. So we have already calculated annuity factor here. Here is annuity factor. Remember, tax is paid in arrears. So for me to get the annuity factor of year 2 to 5, okay, because tax is paid in arrears, so we are calculating tax saved on, you want to calculate, to get the tax saved on interest for year 2 to 5. Therefore, first thing first, you calculate annuity factor of year 1 to 5 at 5%. Remember, cost of borrowing, we're assuming 5%. So we then say, of course, we got 4.329. Then you now calculate discount factor of year 1 at 5%. That's 0.952. The difference will give you 3.377. So that's how we got the annuity factor of year 2 to 5. Okay. Okay, so 3.3, so you now multiply with 4 points. Let's do that. 4.24, 4.24 multiplied by 3.3, is it 3.377? Yes, 3.377. 377 equal, that's 14.31. So rounding, just say 14 or 14.32. Right? 14.32, here is supposed to be 14.32. So that's what we are going to post for that one. This is the final answer, or simply put 14, rounding. So 14.32. Okay, then finally we need to calculate the PV of tax saved on interest. So since all the finance required is only funded with the subsidized loan, the interest element will be computed as follows. So the subsidy amount of 242 Here is 242 million. All right. So the interest on that, the interest rate on the subsidized loan is 2.5%. Come and see. This is the 2.5% we identified from the first one, subsidy rate, 2.5%. So 2.5% of 242 on this 242. So that will give us, bring out the calculator, 242 multiplied by 0.025. That's 6.05. Okay, 6.05. So the interest element on the subsidized loan is 6.05. Let me write it. 242 multiplied by 2.5% equal to 6.05 million. So that's said and done. Then the next thing we need to do now is to calculate the tax saved on the interest. So which is total interest multiplied by company tax rates. Therefore, I would then say equal to 6.05 multiplied by a tax rate of 30%. So this will give us what? So multiply by 0.3. That's 1.815. There is 1.815. Okay. Then the PV of interest. The PV of interest is tax saved multiplied by annuity factor. So here will then be equal to 1.815 multiplied by 3.377. So the final answer will then be equal to multiplied by 3.377 equal, that's 6.13. 6.13. Okay, here is 6.13, rounding 6 million. All right, so that's the final answer. So at this point, let us go and calculate the PV of tax saved on interest, or PV on the financing effects. So since I've corrected the typo error we have there, so we are going to include a different number. So let's calculate by the side. So this will then be equal to, this one will be equal to the PV of issue cost. We got the PV of issue cost. Yes, we got 9.68. 9.68. That's why you have to be very careful when you are picking numbers. So I wanted to pick 242. I mistakenly picked 232. Okay, so this is, what did I say is the PV of issue cost again? Yes, 9.68 PV of issue cost. Then PV of subsidized loan is 6 points. PV of the net subsidy is 14.32. 14.32, 9.68. So here is 9.68. That's 9.7. Since this one is just a 9.68. Then PV of net subsidy equal to 14.32, I think. 14.32, yes. Then PV of tax saved 6.13. 6.13. Okay. 14.32. 14.32 Then the PV on this is tax save is 6.13. Let me confirm. Yes, 6.13. So let's add it up. So this is a minus. So final answer will then be equal to 9.68. Before that, I will say 6.32 plus no, not 6.32, 6.13. 6.13 plus 14.32 equal, then minus 9.68 equal, that's 10.77. 10.77 here is 10.77. So the next thing I need to do now, of course, I can round my number to 11. Okay, so the next thing I need to do is to calculate the adjusted present value, which is step 3. The APV is the base case NPV plus minus PV of financing effects. Our base case NPV is 37. So in this case, here will be 37. Then here is 11. When you add the two together, that's 48 million. Okay, that's 48 million. So since the project produces a positive APV, it means that the project is financially viable and should be considered. Now, we are not going to, there's no way you are going to earn the entire marks of 22, the entire 22 marks if you don't state your assumption. So you need to state all your relevant assumption by saying that the calculation above is based on the following assumptions. Number 1, feasibility study. The feasibility study of 10 million naira is a sunk cost and therefore irrelevant to the project appraiser. So that's one. Then number 2, you need to talk about the cash flow. It's a given kind of when you want to state your assumption, you have to talk about cash flow. And what is the assumption on cash flow? It's assumed that all cash flow estimates are realistic and will occur at the end of each year. In addition, it is believed that the realizable value arising from the disposal of the facility will be achieved. You know, there's a realizable value of about, I think, 10 million naira. So, sorry, 15 million naira. So it is believed that it will be achieved. Otherwise, the decision to accept the project may change as a result of that. Okay, so if not, this may reduce the amount from the NPV. All right. The number 3 assumption is the fixed manufacturing overhead. Remember, the production cost of 150 million. Out of that, we are told that fixed manufacturing overhead of 38 million naira will not change, irrespective of whether the decision is, whether the project is undertaken or not. Therefore, the fixed manufacturing overhead is irrelevant and therefore ignored, since it will not change irrespective of the decision taken. Then we can also talk about the discount rate of financing effect cash flow. Remember, like I told you, you can either assume cost of borrowing or risk-free rate of return. Therefore, borrowing rate of 5% has been assumed as the discount rate for financing effect cash flows, consistent with the M&M preposition. Then number 5, debt issue cost. It is assumed that the debt issue costs are not deductible expense. Examiner even told us that in the question. Then number 6, working capital. It is assumed that the working capital is part of the finance required at the beginning of the project and that any increase in working capital will be financed from the cash flow generated by the project. So subsequently, after year 4, any cash flow, after year 1, any cash flow generated by the project will be financed with the cash flow generated by the project. Then number 7, we also talk about cost of capital. So the cost of capital to be used for the appraiser should be consistent with the project risk and cash flows. Money cash flow for money cost of capital. Again, an appropriate cost of equity ungeared has been calculated using the information of the proxy company, Genzo PLC. Then number 8, we talk about inflation. All relevant cash flow were inflated at the appropriate inflation rates, and it is assumed that inflation rate will not change for the foreseeable future. Otherwise, the decision to accept the project may change. For example, if the inflation rate on the production cost increase beyond what it is, that will lower the NPV, which may affect the decision to accept the project. Then lastly, we talk about financing effect cash flow. So the financing effect cash flow has been calculated on the basis of gross finance required. Remember, I explained that you can either use net finance required or gross finance required. So our assumption here is that we use gross finance required, even though in the question the examiner has told you that you should use gross finance required. So number C of the question the examiner is asking to advise. Okay. Number B, you have to state your assumption. Then number C, you have to advise. So the project is financially viable considering the positive NPV of 47 million naira. Hence, the project should be undertaken. The cash flows from operation contributed 37 million naira benefits, okay, and cash flow from financing attracted additional benefit of 11 million naira, making 48 million naira. So that is end of the question. That's end of the question. Okay. Yeah, that's end of the question. So and that's end of the adjusted present value.